In technical analysis, a technical indicator could be any measure based on price trading volume, market sentiment, or fund flow. They can be used to identify market trends, overbought or oversold situations, and forecast price changes of a security. Technical indicators include price-based indicators like moving averages, and Bollinger Bands and momentum oscillators such as moving average, convergence divergence, relative strength index, stochastic oscillator, etc. Like moving averages, we've learned before, price-based indicators are lagging indicators giving signals after the price trend has already turned, while momentum oscillators could lead the price trend giving signals before a price trend is about to change. In physics, momentum is the strength of the speed of a moving object. In technical analysis, the object is the price of a security. So momentum oscillators measure the acceleration or deceleration of the price trend, but not the actual price level. Momentum oscillators generally fluctuate between a high and low, typically 0 and 100, or across a zero line, highlighting relative strength or weakness within a specific time frame. Because of this feature, extreme highs or lows are easily observable, and they could be viewed as graphic representations of market sentiment when trading activity is more aggressive than normal. Now let's talk about the MACD indicator, one of the most commonly used momentum oscillators, which many traders consider simple yet effective. MACD refers to the moving average convergence divergence oscillator. The indicator could be informative as it is a combination of two different types of indicators. To fully understand it, let's look at its components. MACD is constructed by calculating two lines, the MACD line and the signal line. The MACD line is the difference between a shorter term and longer term. Exponentially smooth moving averages typically 12 days for the shorter term, 1 and 26 days for the longer. Let's say the shorter term EMA has a value of 150 and 140 for the longer term EMA, then the value of the MACD line is 150 minus 140 equals 10. The basic idea of the MACD line is that the shorter term EMA reflects current price action, whereas the longer term one indicates earlier. So if there's a good separation between these two EMAs, it means that the market is trending either up or down. The signal line is an exponentially smooth average of MACD line, typically 9 days. As its name suggests, the signal line is used to identify trading signals, and the difference between the MACD line and the signal line is plotted as a histogram that oscillates around a zero line indicating the strength of the trend. A general interpretation of MACD is that when the MACD histogram is positive and its value increases, the security's upside momentum increases. When the MACD histogram is negative and its value decreases, we have an increasing downside momentum. More specifically, MACD could be used in technical analysis in two ways. The first is to note crossovers of the MACD line and the signal line. Like moving averages crossovers mentioned earlier, a crossover of the MACD line and the signal line may indicate a price trend change. The signal line lags behind the MACD line as it is essentially a moving average of the MACD line. Therefore, if the MACD line crosses above the signal line, it is considered a bullish signal line crossover indicating a bullish trend. When the MACD line crosses below the signal line, a bearish signal line crossover occurs indicating a bearish trend. There is another type of crossover that some traders would note. It is called zero-line crossovers. If the MACD line crosses above the zero line and turns to positive from negative, it is considered a bullish zero-line crossover. A bearish zero-line crossover occurs when the MACD line crosses below the zero line and turns to negative from positive. The second is to look for divergence between the MACD line and the price action. When the MACD line is trending in the same direction as the price, the pattern is convergence. When the two are trending in opposite directions, it is divergence. Divergence with price action indicates the potential weakening or possible reversal of a trend. For example, if the MACD line is trending higher as the price makes a lower low, a bullish divergence occurs indicating that the price movement may turn bullish. Conversely, if the MACD line is trending lower as the price records a higher high, a bearish divergence occurs. Although MACD can be a powerful indicator if used effectively, especially for analyzing the momentum of trends and forecasting their continuance and potential reversal, it has limitations. One of the main problems of MACD is that it may be misused as a means to identify an overbought or oversold situation. Please remember that, unlike many other momentum oscillators, MACD oscillates without defined boundaries. Another drawback is that MACD will often provide early or false signals. Traders may detect a reversal signal on the chart, but no actual reversal occurs. Okay, so much for MACD. Have you got it? In the next video, we'll show you more interesting things. See you next time.